Group Statements, Chapter 7, example where there's a value adjustment necessary on the inventories at acquisition date. Adjustment to the value of inventories of the subsidiary at date of acquisition. The measurement of inventory at date of acquisition in terms of IFRS 3 business combination, which is at fair value, differs from the measurement in terms of IAS 2 inventories, which is at the lower of cost and net realizable value. It is therefore possible that the subsidiary's separate financial statements are correct in terms of their application of IAS 2. But for group statement purposes, the carrying amount of the inventories does not represent its fair value, and a further adjustment to the inventories could then be required at acquisition date through consolidation journal entries. The consolidation journal entry that would be processed if it is assumed that the inventory's value is understated by 20,000 Rand is as follows. Debit inventories of S, credit retained earnings at acquisition date for 20,000 Rand. At the date of acquisition, the net assets, which represents the equity of the subsidiary, should be measured at fair value. That is an IFRS 3 business combinations requirement. The equity item that is affected by the value adjustment to inventories is retained earnings. Any adjustment to inventory, for example, a write-down to NRV or the sale of inventories, affects the cost of sales line item, which is recognized in the profit or loss section of the statement of profit or loss. Profit or loss in return affects retained earnings. Therefore, the credit entry of this journal entry is recognized in retained earnings at acquisition date. The equity item is created so that it is available to eliminate in the at acquisition consolidation journal entry. In the year when the inventory is sold by the subsidiary, the following consolidation journal entry should be accounted for in addition to the journal above. Debit, cost of sales of S, credit, inventories of S. From a group perspective, these inventories have a higher carrying amount than in the separate financial statements of the subsidiary. So the cost of sales coming from the trial balance of the subsidiary is based on the original cost of these inventories. But for group statement purposes, the carrying amount of the inventories have been increased by 20,000 Rand. Therefore, the cost of sales of the group should increase with 20,000 Rand by changing the cost of sales of the subsidiary. This higher cost of sales is accounted for through this consolidation journal entry. Note that the above two journals can also be combined as follows when we consolidate at the end of the reporting period. Debit cost of sales of S, credit retained earnings at 20,000 Rand. You will now note that I'm not changing the inventories balance of the subsidiary, as at the end of the financial reporting period it has been sold. This consolidation journal entry can in all subsequent years now change to be as follows. Instead of having a debit to cost of sales, the debit changes to be against retained earnings opening balance of S, where the cost of sales of S has closed off to. But I will still have to create this retained earnings at acquisition date so that I have it available to eliminate in my at acquisition consolidation journal entry. If you are changing the cost of sales of the subsidiary to change the cost of sales of the group and ultimately the profit of the group, you would have to consider the effect of this journal entry when calculating profit attributable to NCI. If you are changing the retained earnings opening balance of the subsidiary, For purposes of changing the retained earnings opening balance of the group, you would have to consider the effect of this journal entry when calculating retained earnings opening balance attributable to NCI.